Hi, everyone, and welcome to our first webinar of 2023, which is Deal Making 2022, a full year review. My name is Georgia Pask, and I'm in sales strategy for the IB business here at Refinitiv LSEG. I'm joined by my colleagues Matt Toole and Lucille Jones, who lead our Deals Intelligence team. Before we begin, I'll cover a few housekeeping items. On the right of your screen, you should see a Slido available to submit questions you have on today's topics. We'll try and answer as many of them as possible at the end of the session, but please feel free to add them to the Slido throughout. You'll also see various resources at the bottom of your the webinar landing page in the useful information section. These will include the slides that are being presented today. And finally, for those who are looking for it, there will be a recording available of today's webcast. It'll be under the useful information, again, following the webinar today. Now, if we turn to today's topic of discussion, I think it's fair to say that 2022 was no 2021 by any measure, either economically, politically, and certainly not from an IB deal-making landscape. I think perhaps most importantly at this time of year, people are focused on fees. What does that mean? What did it mean, Matt, for global IB fees?
Thanks, Georgia, and you're right. It is a very different story when we look back at the full year 2022 compared to what was a record-breaking 2021. And I think that's probably one of the most important details as we move to the next slide to really hone in on, is that 2021 will be an asterisk for many metrics in many different ways of measuring. As you said, economically, macro levels, many different kind of government metrics, interest rates certainly. And deal making for sure, took advantage of the environment that we saw in 2021. So when we are making comparisons to full year 2022, it is important to note that we are looking at a really record-breaking environment for deal making across nearly every asset class. And certainly you can see that in this chart. So we are down 33% compared to the full year of 2021, and it's quite broad-based. We've seen it in all the bank earnings as they've come through over the course of January, where overall investment banking, advisory, and capital markets were significantly impacted by the year-over-year comparisons. But if you do look at a 10-year or 5-year average, we're still very much in range with where we are in an elevated deal-making environment. We are very much in line with 2017, 18, 19, which were good, significant years for investment banking. And so the pandemic years of 2020, driven by capital markets and so much of the capital markets and capital raising that we saw in 2020, and then 2021, which was driven by a very reduced and very low interest rate environment, kind of really drove fees across every aspect. And so we are at the third highest level for investment banking fees since we began tracking fee records in 2000. And so although a significant decline, still a pretty robust market. And I think there'll be different stories that we'll tell throughout this presentation, but it is a jarring number to see, but it is important to look at kind of some of the broader context, particularly over the last 5 to 10 years. Regionally, the Americas had a really huge impact on the last 2 years, as you can see by that chart. And so that was certainly seen the decline in 2022 with that very dramatic decline from an overall fee perspective. But it really brings us right back down to 2019 levels, basically exactly from an Americas perspective. So we had this outlier of 2020, which was driven very much by US capital markets, a lot of US dollar fundraising, bonds, follow-ons, in the Americas market, and certainly a lot of M&A activity. But really, when you see where we are in 2022, it is very much on par with 2019 and a flat line in 18 and 17. So that story, very much, driven by the Americas as the largest fee pool in the world. But you can see a similar story in Europe. Certainly, Asia Pacific is telling a little bit of a different story as we've seen the capital markets continue to grow there, particularly in debt and equity. And so, the interplay between European fees and deal making and Asia Pacific has been the story for the last 5 or so years. You can see that deals and deal making from Asia have eclipsed Europe for a couple of years here and there. That it kind of goes back and forth. But again, I think certainly an area where we are kind of recalculating kind of just the investment banking landscape right now, and I think you'll see those themes play through as we walk through some of the underliers. If we move to the next slide, this looks at fees by bank region. So the collection of fees from the American banks, from the European banks, and from banks headquartered in Asia Pacific. And you can see the story that I was telling on the previous slide, kind of also make its way through. The top 5 banks have clearly continued to bring the most of capital raising and M&A advice, hovering above 50% for most of this slide for real history. There was certainly an uptick, as I mentioned, during the pandemic years, where many of the US and American banks were able to come in and really can step in and help industries and generally take advantage of market conditions. The decline in European investment banking is not a new story. We've certainly seen headlines over the last number of years with some of the top European banks. This year, in full year 2022, the banks from Asia Pacific have picked up enough market share to fully eclipse European banks for the first time for a full year period, just barely. And you can see over the last decade, the Asian banks have really picked up a good amount of market share. Now, that's a very captive market, very much driven by domestic China activity. So you can see in the ranking on the side, all the big banks are severely, double-digit decline compared to 2021. Some bright spots for those Chinese banks who are doing a good amount of activity domestically in China, but it is a captive market. That fee pool continues to grow, but we aren't seeing obviously non-Chinese banks kind of moving into that space. And so it is a bucket of fees that we are watching, and obviously can also be quite quite bumpy depending on overall conditions in China and kind of what might be happening kind of in some of the capital markets activities. But it is very, very much focused on the bond and loan market. So again, I think in a very interesting picture as we kick off 2023, and kind of see kind of where the investment banking business goes and how that translates into fees. But again, I think an interesting picture at full year 22, kind of the first year kind of post kind of pandemic deal making, and really taking advantage of some of those those real kind of macro trends that we were seeing during the pandemic, and now kind of as banks and deal makers around the world recalculate to kind of see where that brings us in 23.
That's great, Matt. And I think the context that you've explained is really important. 2022, while way down on 2021, it's not actually too far below what we saw prior to the sort of strong pandemic reaction in capital markets and M&A. If we look more in detail at M&A in particular, Lucille, how were deal volumes and values affected, and what did it mean for both cross-border and mega M&A deals, which we know tend to be a bellwether for activity? Go to the next slide.
Global M&A reached $3.6 trillion in 2022, which is down by more than a third from 2021. And we saw a 16% drop in the number of deal announcements as well. So a pronounced drop in activity, but we should remember, as we saw in the last slides, that 2021 was record-breaking in every way, and most definitely an outlier when M&A hit the highest level since our records began in 1980. If we actually compare 2022 to previous years in the chart there on the left, you can see that we're still running at historically a very high level, somewhere between sort of 2019 and 2020 levels. 2022 is actually the 6th highest annual total by dollar value since our records began. And if you look at a 5-year average, sort of prior to 2021, so 2016 to 2020 levels, 2022 was very comparable. We're actually level with the average. From a number of deals perspective, we saw more than 55,000 deals announced last year, which is a level only exceeded once before since our records began, and that was, of course, in 2021. So, again, good to get some perspective against other years and not just compared to 2021. The deal-making environment has certainly changed, though, and it was sort of a year of two halves. In 2021, we saw very easy access to cheap debt, and booming markets made for an environment where deal makers were largely very comfortable pursuing M&A agenda. And this confidence definitely spilled into the start of We saw that deal makers were in a very optimistic mood, and we saw a very active January and February. So a very, very strong start to the year last year. But, you know, the outbreak of the war in Ukraine prompted a decline towards the end of February and into March. You know, after this historic run that you can see on the right-hand side, where global M&A transactions had exceeded the $1 trillion mark for 8 consecutive quarters, we did see deals then fall to under 800 billion in Q3, and we sort of stayed there for Q4 as well. You know, we saw these very volatile stock markets, inflation, rising interest rates, in geopolitical tensions, and that really knocked boardroom confidence and led to a 31% decline from the first half to the second half of the year. So it was a very sharp swing from the first 6 months to the last 6 months. Actually, the sharpest mid-year decline since our records began in 1970. In terms of regions, the US continued to dominate. It accounted 42% of global M&A activity during 2022. And Europe and Asia accounted for 23% each. And you can see the sort of breakout on the right-hand side here. All regions saw large 30 to 40% declines in activity from 2021. The US, which is the blue line here, they saw a 38% decline from 2021's record. Only a 13% fall in the number of deals, though. The US is sort of typically the home of the mega deal, and these deals can really drive activity sort of from a dollar perspective. And when these announcements slow down, as they often do in times of uncertainty, it can really affect the value of M&A in the US, and we certainly saw that last year. Like the global story, we also saw a big difference between the first and the second half of the year as economic conditions deteriorated. So a 41% decline in the US between the first half and the second half of the year. Similarly, in Europe, here in orange, we saw a 39% decline in European deals last year, with a significant slowdown through the year. You know, we had this war on home soil and long-lasting recession fears, and that really knocked corporate confidence. And M&A was, you know, quite severely affected as a result. Still quite a good number of deals in the region, though, down just 10% from 2021 to the second highest level of all time. And then deals involving Asia-Pacific targets declined 32% from 2021. You know, they faced very similar headwinds, but they also faced further waves of COVID restrictions in some areas as well. So they had that to deal with too. We actually saw less of a decline in the value of deals here, but a bigger decline in the number of deal announcements than Europe and the US saw. And they also saw less of a difference between the first and the second half of the year. The second half of the year was down just 18% from the first half, which is slightly different from what we saw in the Americas and in Europe. And now, nearly 6 weeks into 2023, we do have some insight as to, you know, how this year started as well. And I can tell you that we've seen already more than $180 billion worth of M&A deals globally so far this year. It is down 60% compared to last year, and it's the slowest annual start since 2009. We saw a particularly slow January, but we are already seeing a better pace of deal announcements so far this year. So hopefully a better February yet to come. Can we skip on to the next slide, please? Thank you. So here we're looking at cross-border deals on the left and mega deal announcements on the right. So on the left, in the blue, it's a quarterly look at cross-border M&A transactions going back just over 20 years, back to the year 2000. And cross-border deals, it's a category of deals that really sort of takes off when times are good, but it can also drop quite significantly during down periods. And you can see that with the sort of peaks and troughs coinciding with the dot-com boom around sort of 2000 and the 2007 financial crisis. Cross-border deals are just a more risky in nature, and so are a trade. Buyers have the conviction to look overseas for targets, and you can see that cross-border deals fell sharply in early 2020 at the onset of the pandemic, but very quickly rebounded. And we had very high levels of activity throughout the whole of 2021, both in terms of value and in terms of number of deals as well. We absolutely saw a decline last year, down around 30%. Still historically high, but on a definite downward trajectory when we look at sort of the quarterly levels. Buyers in the United States, they drove a lot of this activity last year. They alone initiated just under a third of all acquisitions abroad during 2022. US buyers were in a sort of pretty strong position for cross-border deals last year, with currency fluctuations and depressed valuations across Europe and in the UK. It definitely created some opportunity for US buyers. From a targets perspective, the US is also the most popular destination for cross-border deals, accounting for a fifth of global activity, followed by the UK with 12%. I think the fall in sterling raised the prospect of more inbound deal activity into the UK as buyers look to snap up assets that were significantly cheaper. As a share of M&A, cross-border deals accounted for 32% of total global M&A value last year, which is compared to 37% in 2021. So a slightly smaller share than we've seen in the past. On the right-hand side, the mega deal activity. Mega deals are another sort of category of deals that can drop significantly in a down market. That's what we're looking at on the right-hand side there. We classify mega deals as deals valued at $5 billion or more. And yeah, they're a trait of a more confident market where buyers have the conviction to make these sort of larger investments. And we've really seen these deals drive the dollar value of M&A over the past few years. We saw mega deal announcements drop significantly at the start of the pandemic when planned deals were postponed as corporate leaders hesitated to commit in such uncertain times. But they really returned over the summer of 2020 and they paused in 2021. So we did see a decline last year. Just 89 mega deals were announced throughout the year, and that's 78 less than in 2021. It's quite a significant drop. And again, you can see a definite contraction in the second half where, announcements went on hold as buyers waited to see how the economic picture would evolve.
Okay, great. Lucille, sorry, did I cut you off there?
No. I was just going to
I was going to ask you what the we know that private equity is sort of another fairly leading indicator for M&A. What did the activity look like from them?
Yeah, so if we can switch to the next slide, which does take a look at private equity activity. It's been a very significant story over the past few years. Firms had raised record levels of capital and they were putting that money to work and also taking advantage of some very favourable market conditions, including the very low interest rate environment. In terms of value, buyout groups backed sort of close to $800 billion worth of deals last year, and this is, it is a drop. It's 21, but still 70% more than the previous 5-year average. So, it's I think it was the second highest annual total since our records began. So it's still historically very high. If we look at the number of deal announcements, we saw more than 12,000 deals. And while that's 20% down from 2021's record, it definitely puts 2022 comfortably in second place. And that's all-time second highest annual deal count. So still historically high. But there's no denying that there was definitely a big pullback in the second half of the year. You can see in the chart there that, Q3 and Q4 of last year dropped right down, and the second half saw 57% less deals than the first half. Obviously, their financial equation changes as the credit markets changed, and as interest rates rise, their returns are squeezed as it gets more expensive to finance their transactions. So interesting to see how that story evolves and develops this year.
Yeah, absolutely. I think this is, these are all to be expected outcomes of the broader situation last year. What in terms of the sectors that were in focus last year? Anything, any insights there?
Yeah, so if we switch to the next slide, we can see this is 2022 M&A by target sector in the turquoise, and then the comparison to 2021 underneath in grey. And you can see that every sector saw declines from 2021 last year. Technology was by far the leading sector. It's way out there in front by both value and actually by number of deals as well. We saw more than 11,000 tech deals in 2022, which is 50% more than the closest sector, which was industrials, which saw 7,500 deals. The combined value of these tech deals is more than $700 billion US, which is down by more than a third from 2021. So, a pretty big decline from 2021, but still accounting for 20% of global M&A, the same sort of market share. Digital adoption was, it was only accelerated by the pandemic. It spurred on a lot of activity in this sector, and we're still seeing that activity now. After tech, we have the energy and power sector, which was down 19% from last year. We saw some buyers targeting assets in a bid to capitalise on the increase in oil and gas prices and increased energy demands as a result of the effects of the Russian-Ukraine war. And the energy crisis also reinforced the need for energy supply security, and that generated some activity as well. And then we saw industrials boosted by a bid of more than $50 billion US for Italian by Blackstone and the Benetton family, but still a 20% decline from last year. So those were the top sectors. And then at the bottom are some of the industries that were probably a little bit more affected by the pandemic and continue to be pinched, especially last year by rising inflation and general consumer sentiment. So the likes of consumer and retail.
Great. I can see sort of financials has fallen off. It was probably the second largest sector in 2021, but down to kind of fourth in 2022, which is interesting. Yeah. In terms of just pivoting slightly to SPACs or special purpose acquisition companies, these certainly would have featured really highly in our discussions on M&A and ECM in the couple of years prior to last year. How did they perform in 2022, both Matt and Lucille?
We actually didn't see a single SPAC deal in the top 20 deal list last year, which is very different to what we saw in 2021. Actually, if we take a look at the next slide, where we've got the largest deals of the year, not a single SPAC deal here. If I just walk you through this deal list, and then I think we transactions. So the top deals list, you can see, relating to the previous slide, how tech became the leading sector. Topping this list is Microsoft's offer for video game developer Activision Blizzard, which was announced in January. very closely followed by Broadcom's offer for cloud computing company VMware. Both deals worth in excess of $60 billion US, actually, closer to $70 billion US. And then a little bit further down the list, another tech deal, Elon Musk's $40 billion acquisition of Twitter, which made its way back into the deal list after, being cancelled and then, revived over the summer. So, tech is the leading sector. We can also see the prominence of the US here. Remember that US deals accounted for about 40% of global M&A last year, and 13 deals here involve the US target. So, definite US prominence here. 6 deals are European. Atlantia up there in 4th place. We've got Blackstone's investment in the Dutch warehouse group Mileway, and Germany's nationalisation of energy giant Uniper 2. Asia, we only have one Asian deal here, but it's very big. Right up there in 3rd place, it's India's HDFC Bank's planned acquisition of Housing Development Finance Corp, worth in excess of $60 billion as well. It's actually the largest Indian involvement deal on record, and it pushed Indian M&A to an all-time high. Another thing that I noticed in this deal list here is that most were announced in the first half of the year. And again, it's that theme of a year of 2 halves where, we saw a big decline in M&A in the second half of the year. And, most of the very large mega deals here were announced in the first half. And then private equity, we see a few deals in here. We've got Atlantia, we've got Marway, Citrix, Nielsen, just 4 deals, nowhere near as many as we were seeing in 2021. And all of them announced in the first half again. And lastly, the absence of SPAC deals, the business combinations in this list that featured so strongly in 2021 as that area of the market boomed. And if we flick to the next slide, we can see that, a definite hallmark of 2021. SPACs really took off in the second half of 2020. They are the shell companies that raise funds via a listing with the sole purpose of acquiring a private company to take it public. And we saw almost 300 SPAC combinations in 2021. And these deals accounted for 9% of global M&A activity by value. So, a very significant share. In 2022, SPAC combinations accounted for just 2% of global M&A activity, compared to 9% the previous year. We finished 2022 with 117 billion worth of SPAC combinations, down 78% from 2021. So undoubtedly a decline. But if you look at the chart on the right-hand side, the sort of green one, you'll notice that we did see an increase in deals throughout the year. It's one of the only areas of the market that we saw growth throughout the year. The fourth quarter of last year, we saw more than 80 SPAC combinations, which is a total only exceeded once before at the start of 2021. And there are still SPACs out there looking for business combinations, so we're not done yet. And it all starts with the SPAC listing, which is perhaps where Matt can jump in.
Yeah, well,
absolutely.
We'll go to Matt and talk about ECM now, perhaps.
Yeah, no, absolutely. And I think, the themes are becoming quite clear. The tale of 2 halves, certainly in 2022, we saw the tale of 2 halves for SPAC IPOs in 2021, where, as the market, was really kind of continuing to move, both from a valuations perspective, stock market perspective, private equity fundraising. We saw, obviously an explosion, as you can see on the left-hand side of the chart, of SPAC IPOs in the first half of 2021, which was, quickly met with, a lot of media coverage, many stories, and digging into some of the, the personalities and deal makers behind some of the SPACs, and certainly a lot of regulatory scrutiny scrutiny as well. So, we saw the SEC come forward in the latter half of 2021 with, a bit of a review and questioning some of the disclosure. And so, the rapid decline of the offerings, really, kind of took place as we moved into the second half of 2021. But still, there are a large, kind of from a relative perspective, a good number of entities that are still raising capital. Even into this year, 171 SPAC IPOs raising capital in 2022. If you think about the IPO market that we saw last year, which I will get into in much further detail in the next slide, we only saw 77 traditional IPOs listed in the US last year. And so if 171 SPACs are raising capital globally, there still are potential opportunities, particularly as the impact of kind of the new M&A environment kind of might have valuations and other opportunities for some of these kind of private equity like public structures. And I think it's also important to keep this slide up because we are getting now to that 2-year time horizon that SPAC IPOs have to find combination, and so we may have to begin to overlay particularly some some official announcements or official closures to the extent that we can capture some of that data. But there will need to be a point where these 2-year time horizons have expired, and kind of what happens at that point. And I think that might be some of the story of 2023, because as Lucille noted, we estimate that there could be close to 500 entities that have still not found a combination from the capital that has been raised over the course of the last 2+ years. And so, that might filter into a bit of an M&A story, particularly as there might be some value opportunities for some of these companies, to make a combination. And as Lucille noted, seeing that, that latter half 2022 spike in the number of transactions, is a little bit counter to the story that we're telling. So, I think still an interesting, part of the market, obviously to a much lesser degree than we have seen in previously from an overall percentage perspective of activity, and then also, just a general capital raising activity. But still something to watch, I think.
Absolutely. And so if we look more broadly at ECM, Matt, you're going to dig into those numbers a bit?
Absolutely. On the next slide, we have the view of overall global equity capital markets, which, from a headline perspective, you can see, just the real, kind of, and this is not a story of two halves. This is a story of 2 years and then, a complete decline. The 4 quarters that you see on the right-hand part of this slide are very, very drastically different than the previous 2 years, where we saw, unbelievable levels of IPO activity. And this does not include SPACs, follow-on activity, convertibles. The market that we saw over 2020 and 2021 was a very opportune time to be raising capital for companies to be telling the story from an IPO perspective. And so to start off the year with a worldwide conflict in Europe, and a changing picture as far as many of the kind of indicators that people are looking for. Certainly the VIX, which looks at the fear around the world, and IPOs certainly are very, very, very sensitive to changes in the VIX. So a war certainly would spike some of that, but then following through with obviously inflation, recession fears, and then kind of changes in the overall sentiment of the market, where we saw stock prices moving backwards for the first time in a number of years, really had a huge impact on the equity markets in 2022. And it's just very clear, certainly with a headline number of 62% down globally for all equity issuance, 64% down for IPOs, 61% follow-on, 63% convertibles. It's a very kind of easy chart to memorize because it was so broad-based around the world. There was a number of issues in China, which actually led a number of the Chinese domestic banks to the top of the equity rankings last year, for both IPOs and follow-ons. But in the U.S., for example, it was the slowest year for IPO since 1988, and so kind of really digging back into those records, looking at the overall number of transactions and the overall proceeds raised, an environment that what you probably will not see again. We've seen a couple of IPOs actually start the year. I think many companies, are probably kind of, investigating kind of what the environment is this year. Many commentators are looking at the latter half of 2023 for the return of IPOs around the world, but still some stories to be told, and new filings coming through as well. But I think certainly 22 will be remembered as a particularly down year for equity capital markets bankers and the companies that are looking to make exits. But I think as Lucille noted, a lot of the the private equity and venture capital community certainly is looking at the IPO market as an exit. The M&A market also is an option as well. But again, the interplay between IPO and M&A exit has a lot to do with the surrounding dynamics and the surrounding factors that are kind of driving the market. And so I think everyone is also certainly recalculating now to kind of understand what the new environment is for IPO roadshows and just equity capital raising in general.
Yeah, wow, some really dramatic numbers there for ECM last year. But yes, hopefully a more positive story later in the year there. I think, Matt, sort of turning now to DCM, the story is not quite so dramatic there, perhaps, except maybe in high yield, where to be expected that would be right off.
That's right. I think the corporate bond market, has been kind of, I think if we move to the next slide, kind of, such a driver of activity, and looking at the interplay between, the debt capital markets, the bond market, the loan market, the equity market, kind of looking at all of them and all the tools that, corporate deal makers and treasurers and syndicate desks have to provide to clients. Looking at the two, kind of 2020 and 21 charts, where we saw over 10 trillion in DCM activity for 2 consecutive years. Obviously, a very, very kind of impactful part of the market. For most of the pandemic, we were saying kind of capital markets to the rescue, because we were seeing, so many companies, taking advantage of the market conditions that they probably didn't think they would ever see again post financial crisis. But then also industries that needed to come to the bond market to continue operations. And you saw, the cruise industry and the airline industry and many industries, really being able to take advantage of the conditions that the government and certainly central banks around the world, had set up for the exact reason. But the underwriting banks and the capital markets banks around the world were ready to step in and assist. And so record numbers of capital raised in the debt markets and record number of transactions, you can see, certainly in that chart as well. So as the interest rate environment changed in the middle of 2022, we did see a pretty significant pullback in the offerings, and certainly much of the activity can be driven by, M&A activity, for example. So as M&A falls back, some of the bond underwriting activity will fall back. The refinancing for many companies was probably done during 2020 and 21 to ensure that they could take advantage of, what most people were predicting would potentially be, an interest rate environment that would begin to rise and probably more significantly rise as we got to the latter half of 2022. And we did see that kind of really have a significant impact. From the corporate investment grade perspective, down 13% compared to a year ago. As you mentioned, high yield down 80%. And obviously a very sensitive market for high yield from an industry and interest rate perspective. We did see agency and sovereign debt down just 9% compared to a year ago, and that's a part of the market that has really taken advantage of conditions, and we'll see that as we move into some of the next slides as well. But the agency and kind of sovereign supranational part of the bond market, another area where, particularly in Europe, we're seeing a good amount of activity with some of the vehicles there, and even though interest rates are rising, they still are attractive, relatively attractive compared to some of the previous cycles that we've seen over some of these charts. That sometimes, obviously, some charts go out 20 or more years. The interest rate environments have certainly changed relatively, relative to previous years, but still calculations can be made to make some of the transactions or obviously some of the financing work. So again, I think this will be an interesting market to watch this year. I think lots of news even this week around expected interest rate increases from central banks around the world. and what does some of the data that's coming in, how does that impact some of the decisions where we might see some easing on some of the pace of interest rates, and where we might be good to see some leveling off, so people have a little bit more of a sense of where things might be, kind of heading into the latter half of this year. But obviously a huge part of the market, and still relatively robust in 2022 and as we move into this year as well.
Okay, interesting. And we spent a lot of time at LSEG Refinitiv looking at sustainable finance data in particular. Do you want to talk through how that was impacted last year, Matt?
Sure. On the next slide, we have kind of an overview of the very high level view of sustainable finance, which looks at a number of different types of transactions as well as companies that we deem sustainable. So we have a very high level view, which then we can dig in and look at different parts of the market. It's a market particularly driven by green bonds, which has been around since 2015. But at the level of increase that we've seen over the last 3 years has been pretty extraordinary as the world of sustainable investing, sustainable finance, and commitments from global banks around the world to move in and underwrite and loan and advise in this part of the market, has been really pretty astounding to watch, particularly as banks have organized themselves around the sustainable book of business, looking at sustainable products for many issuers in many different industries. But we did see the first year-over-year decline since we've been tracking kind of this overall market, which began in 2015, and a lot of the growth of the market did come from the pandemic, where we saw, the rise of social bonds and sustainability bonds, kind of really looking at, kind of pandemic relief. And I think, you can see that certainly in the chart, it's a pretty significant, but measured decline as we ended the full year 2022. So a good amount of it is, certainly based on market conditions. If you're looking to raise capital, what kind of capital can you raise? Certainly, I think also there's a certain number of issuers who raised their first green or social or sustainable bond in 2020, 2021, and don't need to be coming to the market. So this is going to be a little bit of a bumpier market. You're not going to have the constant kind of issuance. As banks report earnings, you see multi-billion-dollar bond offerings pretty much like clockwork as the earnings reports come through. The green bond market, the social bond market is going to be a little bit bumpier, based on the issuer profile. And so, for some of the issuers that we saw with their inaugural offerings in 2021 and 2022, we're not going to see them back in the market for a couple of years, but we still do continue to see inaugural, green and social and sustainable bonds come to market. We had General Motors at the end of last year with their first ever green bond. Comcast joined just yesterday with their first green bond. And so there are some very kind of big names that are still exploring this market. And so I think it is one to watch. Also the use of proceeds of these offerings are going to have to kind of be transparent for the investor community as we continue to see this market grow. And so I think there's a lot of focus on the market, but also you could imagine, with the changing interest rate environments and just the changing environment in general, this part of the market might not be the top of some treasurer's to-do list, although it might be something in the future, that might be, an attractive way to come to market and bring in some, potentially some new investors into your bond profile. But I think, the overall percentage of green and sustainable bonds as a percentage of overall debt has remained steady over the last 3 years at about 10%. And the percentage of corporate debt is at 9%. And so even though we are seeing declines in all the markets, the overall percentage of sustainable finance as a percentage of the global market has stayed quite consistent over the last year or two. And so that's another metric to look at, that, although not every issuer is going to be able to come back every year. There are new issuers coming in and bringing in new kind of new areas of focus. And we've also seen a number of transaction types as we begin to track more and more. We saw climate bonds, transition bonds are certainly something that I think a lot of investors and issuers are looking at. And also the switch from the use of proceeds bond to the linked bond. And so that's been happening for the last year or so, but sustainable linked loans and sustainable linked bonds, where the coupon is actually based on a KPI that the issuer obviously says we're going to meet or exceed, potentially a goal. And if that happens, the coupon will change in lockstep to that KPI, and it could be to the positive, and it could also be to the negative. But investors actually moving into the space saying, okay, we invested in your use of proceeds bond, where you said you're going to do this with the proceeds, but now let's move into this linked structure where we're going to actually hold you accountable to a KPI that you're going to publish in the market, and we can all see. And so we are seeing some shifts in the underlying structure of these transactions, which is interesting to watch as we move into this year and this interest rate environment as well.
Yeah, wow, thanks, Matt. As you said, I think this is a key area to watch, particularly as more linked bonds come online, but also as more debut green bond issuers come to the market. So very, very interesting. We're now going to move to some Q&A, and I would encourage you, if you have got questions about the slides or any sort of related topic, please put them in Slido, and we will hopefully get to them. We do have an initial question here, which is coming out of the Middle East, just wanting to better understand how that market performed in 2022 in terms of, I guess, the various products, and maybe Lucille, you can give us a bit more background on that.
Yeah, I can give you some background there. So the Middle East was actually one of the sort of rare bright spots. We saw a very buoyant market for both M&A and IPO activity there. We saw a record number of deals with Middle Eastern involvement, with high levels of both domestic and cross-border activity, and deal making was actually strong throughout the year. We didn't see that pronounced drop in activity that we saw globally between the first and the second half. So very buoyant M&A market. We also saw a booming Middle Eastern IPO market, very much in contrast to the global story that Matt just showed. Were less stable. Their regional indices outperformed global benchmarks, and there was the IMF were much more positive about their economic outlook. So we saw soaring energy prices benefiting the region, and investors showed a lot of confidence in the long-term economic growth. So demand for share sales in the Middle East was very high. So the Middle East was definitely a bright spot last year.
Okay, and then I guess leading on from that slightly, we've got another question here, which is, if Matt and Lucille, if you can get your crystal balls out for 2023, there's a question come in on sort of what do you think, how do you think the deal making environment is going to play out this year? And where do you see sort of products or sectors that might come out strongly?
Should we both have a stab at it?
The crystal ball is so difficult. I think I've been using the word I think I already used it here, but the deal making market is kind of recalculating and you kind of almost buffering, as you would imagine on a slow internet or Wi-Fi signal. Trying to figure out kind of what the environment is, where there might be areas of opportunity. I think when you see the valuations of companies coming down, when you see stock prices begin to come down, when you see kind of some full scale changes in some of the industries that we've been watching, I think that brings opportunity. And I think the bond markets, although more expensive, they are still something that could be in the bond and loan markets, certainly something for for a number of companies that could take advantage of these changing conditions. So I think if we begin to see kind of continued kind of declines in some of the metrics that that a lot of people are looking at, like inflation, other areas, so obviously the job numbers that came through earlier last week in the US had a very different story than many were expecting. But I think oftentimes in these downturns there are opportunities, particularly for companies to come together out of necessity, taking opportunity of some of the disjointed areas, and then private equity, certainly the capital that has been raised is still out there for a number of the larger companies, and so potentially the valuation story might change the the equation for them as well.
Yeah, I would say that 20 financing piece. This era of super cheap money has come to an end, although, historically not as interest rates are as high as they have been, but, still pretty high, and have risen, fairly sharply. That's going to be a big challenge. And then, global tensions, boardroom confidence, to make acquisitions, also valuations, even when there is, money available and an appetite for deals. It's proving very tricky right now to value companies, very difficult for buyers to assess with confidence what targets are worth, and also for buyers and for targets to agree on that value. So, definitely some challenges. And I think, this overall cautiousness to do deals will continue just until we see, calmer markets and until valuations settle down and perhaps activity will, pick up more towards the end of the year when things become a little bit clearer.
Okay, yeah. And then we've got, I guess I had a question which was around sort of what sectors do you think are going to be potentially hot this year? There's also a question in Slido on I'm looking out for sort of more IPOs coming out of sort of large startups now, sort of fairly sizable companies. What do we expect to see in the market there?
Sector-wise, I think we could see more in the energy and power sector. I mentioned earlier that the increase in demands for energy and the need for energy supply security certainly drove activity last year. This year, energy producers, they are generating record revenues, and perhaps with their need and their want to decarbonise, we might see them using some of their growing cash reserves to invest in new green technologies and renewables this year. So that could spur on some activity in the energy and power sector.
Thanks, Lucille. Matt, any thoughts on IPOs? Oh,
just lost my camera. But I think from an IPO perspective, certainly, the startups, the startup community certainly is the one that is probably the most interested in having the IPO market come back. The exit for investors, for certainly for employees, is interesting dynamic that has been very much a drought for the year. So I think it'll be interesting to see if market conditions begin to improve or steady off a bit, could some of the startups, some of the larger startups, kind of in the venture-backed space, be able to come to market and begin to be kind of the boon that that I think the market is looking for from an IPO perspective. I think it will be led by either private equity or venture exits, which is where we've probably seen a good amount of the drought in 2022.
Another area to watch, certainly, as we get further into the year. And I think we will obviously, Matt and Lucille continue to do analysis all the time of the markets as they develop and quarterly reports, and we'll look to report back here through webinars in the next few months as well to see how things are developing and further the conversation. We do want to thank everyone at this point for dialing in, and thank you for your engagement and your questions on Slido during the webinar. As I mentioned at the beginning, the slides that Matt and Lucille presented will be available under the useful information section on the webinar landing page, and the recording will be added shortly as soon as it's available. Also, just a note to look out for results and insights in the next couple of weeks on our 2022 annual Dealmakers survey. So that's a few hundred people in the financial industry surveyed on their thoughts of what's going to be happening this year. So we're gathering the insights now, and we'll be reporting back on that soon. And then a final shout out, as you can see on the screen here, to our Refinitiv Academy courses. These courses provide essential how-tos and learning for Refinitiv workspace users to help you to gain insights and make the most of the data that's available on our platform. So 2 sessions that are upcoming, both next week. The first one is looking at the data presented today and is going to show you how to replicate the charts and pull the same or similar insights from the data in Workspace. And then the second one is going to be a deep dive more into sustainable finance and ESG data, which we spoke about briefly, but there's always a lot more to say on that topic. For further information on these courses and others that the Academy is offering, please go to refinitiv.com/learning. And then finally, just thank you very much, everyone, again for joining. And we hope to see you on the next webinar and also on the Academy courses sometime very soon. Thanks again.